Thank you very much, moderator. And PMS Bazaar, first of all, I'd like to thank my dear friend Pallav Rajan and his amazing team for, trying to inculcate a culture of dialogue-based investing where they get some of the best minds in the field of investing across asset class, not only equities, at various platforms. I've been associated with Pallav's PMS Bazaar outfit for almost 10 years in various capacities in my previous avatar. So I'm very glad to be here with you all today in Dubai. And thank you very much for staying back after such a educative and slightly scary presentation which Shankar actually made. It's kind of slightly challenging for us, all of us here. These are all my friends and stalwarts in their own ways in the industry sitting. And we were wondering and chatting among ourselves that where to take our discussion idea, topic is Indian market ready for takeoff? And Shankar, with his experience alone, we have our collective experience in the markets as much as he has seen the market. But still, we'll try to do a balancing and go in the nitty-gritties of their individual styles of investing and how they are analyzing the market opportunity right now. And if you remember, even Shankar was making a point passingly in the end, towards the end. He's not saying exit India markets at all. He's saying it will become a trader's market than a trending market. It will not be an easy market, just you buy and hold for 5 years. You should know where your entries are, exits are, triggers are, and my co-panelists over here are exactly experts of that. So before I go to each one of them in understanding how each one of them is the individual style of investing and analysis, let's try and paint the picture right now. Kahan khade hain? Where are we standing right now in the market and how much is the damage? What does it look like? A market versus economy, and then we can individually scratch their brains on how they are approaching, because that's where the alpha lies. So, gentlemen, great to have you all. Viral, let me start with you. So we all know that valuation was the argument which we were padding up with, ki high earnings growth is there, so much is there. But the speed at which narrative changed in India in the last 6-7 months, especially September, October onwards. Now in hindsight, we are seeing ki growth to April May se ruk gayi thi. Pre-elections, actually, the government's focus started moving away from growth and perhaps towards elections and all of that, new tendering activity. Baad the valuation expensive. I want to understand from you, now that all of that has happened and dust has settled down, and we are 20-25% low from the top on mid-cap, small-cap particularly. How are you analyzing each of those factors because of which this kind of a correction after a big 4-year run actually came? How are you looking at the things right now?
Sure. So actually, we talk about the 4-year sort of bull market, but if you think of it last 9 years, right? Nifty had given positive returns for each of the last 9 years. So somehow the investor psyche was that buy the dip. Every time you bought the dip, within 3 to 6 months in most cases, you sort of started getting positive returns. So that probably that investor psyche is right now getting challenged. That's one. Secondly, valuations, especially in some of the sort of themes or narratives, had gone to extremes. Like 100 times was being easily written in sell-side reports, and that sort of has started getting corrected. Now again, what happens is you see a 5-10% correction, that by the dip psyche happens. But because this has been longish, right? Nifty peaked in September, BSE small cap, which I think is the best measure. It has 900 stocks. That peaked in December. So it's just been 3 months. But now people are challenging that. So on valuations, while if you look at the broader market, the Nifty, it's not too expensive. Maybe we are slightly above average depending on what you count. Will become more expensive once Jio and Zomato enter the indices. But sort of keeping that aside, it's still not too expensive there. What's expensive still is narrative, right? Stocks that have gone up 15, 20, 30 times. At least in our view, a lot of those are not justified. And, maybe there is no rush to buy that in. So, after such a long sort of 9 years bull market, if there is a cool off, that whole cool off period also might be extended. You sort of don't stop running and again start running again. Typically, those bear market phases, if they may be called, historically, at least in US, India doesn't have long enough data. Your smallest one is 9 months, typically goes up to 27 odd months. So that's the kind of time frame one should be prepared for.
Okay, Satish, you have your fund almost $1 billion plus dollars, and you particularly look at large caps.
Yeah, I look at large.
When Viral said that earnings are perhaps not that great and mid cap, small cap, how this argument that large caps are safe right now, valuation versus earnings comfort, the third quarter earnings just ended. Is it like there is no choice? We should actually have a tilt towards large caps, or genuinely valuations versus earning argument is very strong? Because many say 50% of large cap and Nifty itself have very low growth.
No, so broadly, if you look at the overall universe, you cannot paint everything in the same basket, right? Within mid caps, you will find stocks which meet your desired criteria of durability of growth and longevity of growth. Do these stocks kind of can trade at a higher multiple or can give you desired return? Answer is yes. If you look at Nifty, last quarter which went by, overall Nifty stocks results were less disappointing, or I would say it was in line as compared to what has happened to small and mid cap space. Overall, when you look at FY26 growth expectation on the Nifty side, the consensus expectation is still around 13 to 14% kind of growth. Viral did point out that there were certain froth in certain segments of the stock, which were built more on narratives rather than earnings delivery. At our investment thesis is always on the basis of whether earnings delivery is happening or not, and we tend to value stocks based on certain parameters, both on the financial and on the operating side as such. So we still feel there are pockets of overvaluation in certain pockets, more maybe on the small and mid cap space. Now, large cap space also, why people do invest in mid cap and small cap is generally because there is a slightly higher return what you get to handle that volatility. So over a longer period of time. So as long as that is met, I think investors are fine maneuvering that volatility. So it's a call as an investor or as a fund manager, what you are doing. I think what kind of desired return, what you expect from stocks. Overall, our view is that given the correction, market has definitely become slightly fair to reasonable valuation, and you can get decent return from here on.
Anirudh, I'll come to you, and after that I'll come to you, Bala. Yours is the hardest job, which is small cap. You're a specialist in small cap, mid caps. I have many questions for you, but let me get over with the macro argument. Anirudh is someone who tracks macros as much as he does stocks and micro. Anirudh, is the growth fear or scare or the negativity around the 5.5% print which we saw last time, is that done? Are you expecting macro growth to improve from here on? Because after all, earnings in general are also a derivative of what's happening in the economy. Or you think it's not out of woods yet and it's still a key monitorable?
Absolutely. So I would say that if I look at this FY25, the first and the second quarter was extremely bad. Now we have to look at the factors why the first and the second quarter was bad. So historically, any year when you have the elections, infra, capex, I would say 4 to 5 months, it takes a kind of the back foot. From April, May, June, July, that was the period when all the capex activity was extremely slow. Now, if I look at the last 1 year, the two big points, pain points rather, one was capex was weak, second, urban consumption was weak. Now, capex was weak, yes, because of elections. Urban consumption was weak because part of it is to do with the income growth. Second is because of I would say the wealth effect. And the third is, yes, when capex is weak, it doesn't translate to the consumption. Now, if I see where we have ended, or rather where we will end FY25 on the budgeted capex. Now, in the budget, the government, they did the rebasing of the capex from 11.2, it came down to around 10.1, 10.2. If we have to achieve that 10.1, 10.2 for FY25, that translates to almost 18 to 20% capex growth in this quarter.
And market is ignoring that.
which means that market is ignoring the fact if you have to achieve that capex of the 10.1, 10.2 by end of FY25, in this quarter, you need to have 18-20% capex growth, which means your fourth quarter numbers, which will come from, say, April, May, June of next year, they will come exceptionally good compared to what we saw the last year. If you look at all the cap good companies, all the industrial companies, they all said that, yes, capex ordering has been weak, etc. But yes, we are quite hopeful. So I would say that is one part wherein I would say earnings is going to pick up. This quarter, we ended at roughly around 8% kind of an earnings growth. We should end FY25 at roughly 7% earnings growth. As he mentioned, I think for FY26, even the most pessimistic estimates for Nifty earnings is around 11%. And most optimistic is around 14 to 16%. Let's take an average of around 12 to 13%. If you take a 12 to 13% FY26 Nifty earnings growth, you are getting FY26 Nifty at around 19 times price to earning. FY27 Nifty should do around 16 to 17% earnings growth. You are getting FY27 at 16.1 times price to earnings. So this is just the headline index. Small cap is the part where the interesting part is. Small cap FY26 should do again a similar like a 11 to 12% earnings growth. Valuation wise on FY26, the Nifty small cap 100 is around 19.5 to 20 times. FY27 small cap index should do around 22% earnings growth, and these are estimates of the street. It is quoting at 17p, which means you are getting the small cap index at below 1 times the price to earnings, the growth ratio.
I saw you tweeted this data, but which created quite a lot of discussion in the market. Some are saying it is on the very optimistic side, I must tell you. But that point, before I go to Balaji, that when the macro data was deteriorating, market was peaking out. Market actually fell 3 to 4 months after the weakness in macro data accelerated. So probably this time when the market bottoms out, the macro data will actually bottom out 3-4 months before the market actually bottoms out. So there's a lag effect on both sides. But Balaji, who's a expert in small cap, mid cap, and we all know that last 5-6 years, a lot of Indian investors have got very reasonable exposure in small cap, mid cap, and of course a great experience. But it's a very tough area you navigate, Balaji. Tell me, how are you analyzing the first stupendous returns last 5 years, then the decent crash, and actually the small cap index fall is masking the real plane. If you ask many of our investor friends here, they know the small cap, mid cap index 30, 40, even 50%. So have you written off that area or are there challenges? How are you approaching the small cap space?
Thanks, Ajay. So here we need to understand large caps a little, compared to what large caps were, say 20, 25 years back and what it is now. It is almost kind of become imperative for the Indian investor to have bulk of their exposure to the mid and small cap segment because of the heavy disruption that we are seeing in the large caps. In my humble opinion, the real large caps in India are not the large caps as represented by Nifty 50. The real large caps in India are companies like Apple, Facebook, Amazon, YouTube, Instagram, Microsoft. These companies are now today commanding a turnover which is greater than Cipla, Sun Pharma, Dr. Reddy's and Bajaj and Hero and all these type of players. And therefore, if you look at the growth in large caps, the unlisted space, the large cap growth is far, far superior than the listed space. Whereas earlier times, I'm talking about early 2000s, the large caps did extremely well because a lot of segments were still unorganized, our two-wheeler penetration was low, four-wheeler penetration was nothing great, bank accounts were not great, penetration was nothing great. But today that scenario has changed, but Nifty more or less has this, same kind of constituents. In my humble opinion, almost 70% of Nifty constituents, the businesses are commoditized. You have 35% in financials straight away, which is commoditized. You have 10% in oil and gas, which is again commoditized. You have 7% in auto. Whereas in auto, for example, you have Maruti, you have Tata Motors, you have M&M and all these companies in the index. But the growth is coming in Kia and 𝐵𝐺 and BYD and all these companies which are outside the index. Paint was a 5-player market, Asian Paints, Berger, Kansai, Nerolac and Indigo. Today it's become a 9-player market with the entry of Pidilite, Astral and Grasim and Birla and all these. So in my humble opinion, the large caps seem to be much more prone. Unfortunately, there seems to be a situation where people think that our large caps are something similar to NASDAQ. It is not the case because NASDAQ revenue is much global and our revenue is not like that. So the fall in mid cap and small cap, it's the nature of the beast. We have seen that in the past. Beyond the top 100 stocks, liquidity is not great. Therefore, the moves on both sides are exaggerated. So I would continue to stick with mid and small and think that in the next 4-5 years with increased GST compliance and unorganized to organized, and especially with this recent correction, a lot of companies are looking attractive in my books.
Sure. In the benefit of our attendees today at for this event, I want to understand in brief, very quickly, if one minute each, on how are you guys positioned right now in this market? Karne ka kya? Because all that eventually boils down to distilled, aap kya karna chahiye? A lot of time, sometimes so much negativeness is painted, people feel like, yeah, 50% hata do portfolio, fixed income mein aa jaun, alternates or something like that. People are contemplating massive changes in their portfolio. So what is the prudent strategy right now? What you guys are recommending to your clients? If you can, we can start with Anirudh. Bazaar ghata hai top se. Mid cap, small cap people are kind of exiting now. FIs are selling this, that. What's the right approach in your portfolios to take? 2 minutes.
See, I'll say like, if I talk to any investor out there, basically there are the two set of investors. One who's completely invested, because we keep saying you buy the dip, but you should have the money to buy in the dip. So there are two set of investors. One is who's completely invested. Second is the guy who has some cash. So anyone who has incremental cash flows, we are saying deploy it over the next 4-5 months. There is no hurry to deploy because markets are not going to go anywhere.
So phased deployment is
do a phased deployment, because the biggest trigger for the markets, and there is no way of a second thought to it, biggest trigger will be the earnings picking up, which we expect that from say the first quarter of FY26 onwards, you should see the earnings picking up. So earnings picking up from the first quarter, you have 4-5 months. So deploy the money in a phased manner. Second, on the market cap, as of now, around 40% is into the large cap. I continue to have around 40% into the small cap. Simple reason, small cap definition of India is not the same small cap definition what we had earlier. As per AMFI, the first small cap company is a 33,000 crore company. Now that is not a small company by any measure. So I would say look for companies where earnings growth is there and valuations have become comfortable. Deploy over the next 4-5 months.
Balaji, you made a great point that your investment strategy may be termed as small cap, mid cap, but actually you are looking at tomorrow's Havels, tomorrow's TVS Motors and tomorrow's category leaders. So that's what how are you approaching market right now out of the portfolio which you already have and the new flow or inquiry which are coming? What are you telling them for the next 1 or 2 years, however bad the market may be? Nobody can time that.
We clearly tell them that we are no experts in asset allocation. So you can, you can't be a fast bowler, spinner, batsman, all in all, right? So I don't know, I don't, things like whether there is gold in Fort Knox and Bank of India, these are all uncontrollables. So when you call yourself a bottom-up guy, I should go in depth of a stock and see what are my so-called controllables.
Sure.
So we don't really take humongous cash calls in the portfolio based on macro environment. We are invested to the tune of 90 to 92% at this point in time. We do call for money considering that there's been a significant drawdown. Like you mentioned, there are 30-40% stocks that have been down 30-40-50%. And what we are doing is within our portfolio, we are navigating, maybe we are pruning some names, we are adding to those names where market is ignoring the good news.
Sure.
So for example, there are two companies, X and Y. X is gaining more market share from Y, but still, there has been a drawdown in that stock. Or there has been a positive policy change which is done by the government for that particular sector, which is going to impact the fundamentals of the number one listed player positively, but still market doesn't pay any heed to it. The stock is down, say 30%, 40%. We try to add more into those type of names.
So you already started buying such names? You already deploying?
Yes.
Okay. Satish, what about you?
Yeah, so we also as a house, we don't take large cash calls, and generally our cash calls is in a range unless we see some binary event on the macro side. See, overall, our stock selection process is like we look at certain parameters which meets our earnings growth and operating matrix criteria. I think what Balaji highlighted that we do give a lot of emphasis on the operating matrix, because I think financial matrix is the last to come, because if the company is improving on the operating side, financial side will definitely improve, and market share is one of the key things what we look for. So we have allocated some funds recently and reduced our cash position, and some rebalancing which generally happens in any drawdown because certain names becomes quite attractive given the growth outlook. Overall, having said that, I think we do look at opportunities from a slightly longer term, which is 3 to 5 year perspective. But any changes which impacts our portfolio companies' dynamics, we closely monitor that, and if any derailment of investment thesis is there, we do take corrective action and try to take advantage of that. That's our investment thesis.
विरल भाई, क्या करने का बाजार में? Portfolio से 30% down है.
Sure. So, we are huge believers in cycles, and typically in a down cycle, the smaller caps tend to fall 2 times the larger caps, right? So we have pivoted more into large caps. We do take cash.
But you'll equally fast come back to when the time is.
Yeah. So,
Okay.
during COVID, we were like 80% mid and small caps. So right now we are into 50% large caps. So we do take cash calls. We were like 16-17% cash in September, October, PMSes combined. We have deployed a little bit. So we are now like 13-14% cash. We think, it's a cliche, but a market like this, right, which is range bound, that is a stock pickers market. That's the time, fund managers can actually add value. We are probably in that phase. It is a stock pickers market. You take those calls, and so also take sector calls, right? You get your sector calls right. That also generates significant alpha, if you sort of can overlay to your stock calls. So that's what we are doing. 3 or 4 sectors, we have 0 exposure currently.
Okay, so let's talk about, they say that, you should never ask a fund manager what to do. You should ask first manager, how are you positioned? Because there could be some variance in that. So let's understand from you guys, how are you positioned right now? Anirudh, what are your 3-4 big overweights right now? What have you completely exited? Give us a flavor. See, there is no media and I'm no longer in media, right? You want to take some examples, go ahead. But I want to understand the crux of your positioning of your portfolio.
See, as of now, I would say almost 60% of my portfolio is into the 2 sectoral themes. One is urban consumption, second is industrialization. Or I would say domestic capex, industrials, whatever it is.
And this at a time when people are writing off capex.
So I would say if you have to bet on India, you have to bet on these 2 themes.
So fallen capital goods is an area you should look
at. So I would say when I say capex, it includes multiple things, and I'm very bullish on the energy space. So power capex is something which I'm very bullish on. Almost 14-15% exposure is into the power capex, because power capex is something which is happening as we speak. India continues to be a deficient country when it comes to power. Irrespective of the source of power, could be the renewables, could be the non-renewables, I'm betting on the intermediaries of power. Companies who will benefit irrespective of the source of power.
The value chain.
Because, exactly, the value chain. Because if you produce a power at one place, the consumer is always away.
So powers and cables.
Exactly. So power EPC, power transmission, transformer, the wires and cables. These are the guys who invariably will have to grow.
Right.
Second big allocation is into your urban consumption. That continues to be my largest allocation, because India is one of those countries where we produce and we consume.
What is urban consumption?
Now, when I say urban consumption, basically where do people like us, we spend money? One part of our money goes into the real estate and ancillaries. Of late, I have decreased my exposure into the real estate. I have been very bullish on the real estate for the last 36 months. I have decreased my exposure. Second large allocation is your consumer discretionary, which includes all the new age companies like your Zomato, Tata Trent is something, which we continue to hold. Zomato people have been kind of, very pessimistic, and I'll talk about it. That, if you look at the recent numbers, Zomato people were concerned about the numbers which came in the loss. But I would say they are investing for the growth. They have preponed the capex. The number of dark stores they wanted to open till December 26, they preponed the capex to December 25. Now that shows the management is going all out in the battle of the quick commerce.
Sure.
So urban consumption 35% and around 25% is your industrials.
That's a formula a lot of people actually deploy, isn't it? Where companies are front loading the capex, the earnings could be impacted 2-3 years, but later on J-curve in earnings happen.
Absolutely.
Balaji, you tell me what kind of stocks, can you talk stocks or certain sector you got or whole out in last 3-4 months?
So our way of looking at this is we essentially look for companies that are growing greater than the nominal GDP by 1.5 to 2x. So nominal GDP is about 10-11%. So you look for industries and companies that grow by 1.5 to 2x the nominal GDP. So if you want nominal GDP returns, the best thing is nobody needs people like us. You know, a low cost Nifty index fund will solve the job for them. So within that, we like the furniture segment. So when you talk about a particular sector, there can be a winner, there can be a loser within that sector. So for example, say travel sector. So you could have paid travel via the luggage sector. So if you had adopted a top-down approach, and bought the leader, which is VIP, you would have made 0 returns. But Safari gave a 12x return. Similarly, if you are talking about say furniture, you have the plywood industry, which is probably growing at 4-5%, but whereas MDF industry is growing at maybe 12-13%. So MDF manufacturer is gaining more market share from somebody like plywood. So is there a probability of making reasonable returns on the largest listed MDF manufacturer in the country? The answer is yes. So a company like probably Green Panel. Then we really like the testing theme. So everything in India is going to be tested. So last year we had bad optics with some of the masala companies getting bad press due to the contamination and stuff like that. So whether it is electronics, fruits, vegetables, of course clinical trials, all of these are going to get tested in a huge way.
So CRO companies is what you like?
CRO, even electronic testing, all these, you have companies like Vimta which are into testing. And we also like value-added dairy. So Indians generally, the tendency was to buy the milk and make the byproducts of milk at home. But now with women participation in the labor force going significantly higher, the byproducts being bought at home is now a new normal. So whether
nobody
it is,
makes ghee at home anymore.
Yeah. So whether it is cheese, paneer, ghee, buttermilk, ice cream as a sector looks very exciting to me because we've hardly scratched the surface. Power demand, your power penetration in India is almost 98%, and roads have gotten better. So even a rural shopkeeper is able to stock a fridge, and by virtue of that, he is able to stock ice cream. So even a rural child is able to enjoy a 40-50 rupees ice cream. And ice cream was a very seasonal, summer only kind of a thing. So when I traveled to Ahmedabad 3 months back, even during peak winter, there was crowd outside the ice cream parlor. So even during winter, people have started consuming ice creams. So that's why even unlisted companies like Lotte and all these companies are investing in capex.
Okay.
So we like value-added dairy, we like furniture, we like the fact that 3 out of 4 cars in 2008 was a hatchback which was sold in this country. Today 2 out of 3 cars are being SUVs and mini SUVs. From a mileage-based buying, we have gone into a feature-based buying. Therefore, the second derivatives, the ancillaries which supply to these SUVs and mini SUVs,
value-added auto ancillary.
Yeah, I think they will see faster growth as well.
Satish?
Yeah, so Ajay, we are totally bottoms up in our stock approach, and our sectoral allocation is more of an outcome rather than a starting point. So now businesses which meet our criteria in terms of growth and valuation outlook are certain pockets of consumer discretionary. Now within discretionary, I think we do like aviation as a story. I think there's a structural change which is happening, and there are industry tailwinds as well as the cost tailwinds. We own the leader out there. We do own the value retailer which Anirudh spoke about. I think despite recently the stock has corrected, but I think if you take a 4 to 5 year kind of a view, I think this continues to be a 25% CAGR kind of a story. They are seeding multiple businesses, new formats, which has a lot of optionality into it. And despite growing 4x in last 3 years, they have done it profitably, right? So these are the names. We also like our exposure on an overall sectoral wide is higher on the financials. But when you look at financials, I think subsets of financials which are not into lending, right? I think there are insurance spaces which are growing at around 16 to 18%, delivers you around 18 to 20% kind of ROE. There are niche NBFCs which have benefited on account of, let's say, gold financial, which has benefited a lot on account of competition exiting the space and the entire penny on the MFI and the unsecured lending side. So we have exposure to all these names. We like certain aspects of, as I said, consumption, liquor consumption. We do on your Zomato of the world. I think what we like about these stories is that there is non-linear growth, what you get as an investor. Balaji spoke about what we look at, that he looks at a company which grows at 1.5 to 2x kind of GDP. Our investment thesis is also that to identify companies, because we don't own more than 20-25 companies. Dinshaw presented that they are good stocks, right? I think there will always, in a bad market also, you will find certain good stocks or certain names which are growing meaningfully ahead of the market. So our idea as a fund manager across, I think all of us, is to identify those names.
So liquor falls on which basket? You said, I like liquor stocks.
Yeah, so we do own United Spirits. Again, out here, if you look at it, I think they have been gaining market share. They have front-ended the investments a lot. In terms of increasing their ad spend. So earlier they used to lose market share to Pernod Ricard. Now they are launching new products. There is renewed aggression.
Is it not very aggressive, competitive landscape? Radico is getting very competitive. I saw their ad, Royal Ranthambore or something.
See, but broadly, if you look at the entire liquor industry as such, the Indian market is a huge opportunity, right? When you look at the opportunity scale, I think 1 year can be a low growth kind of an environment. But when you look at a longer term picture, the picture looks quite bullish.
Okay.
At times, the fallacy of Excel sheet modeling is this, that
Correct.
I think 1 year may not turn out to be as how you want it to be, but overall the growth story looks quite decent out here.
Okay, Viral, your overweights right now, what have you done? What have you bought last 3-4 months in the correction?
Sure. So, like Satish, we are big in financials. The biggest weights are in financials.
But which financial? Financial is
banking. So,
banks.
banking, we have a gold financer, not at this price, but when it was at distressed valuations a few months back. We like insurance. Insurance, both life and non-life. The new insurance act will be tabled in winter session, and also the accounting will change eventually. So I think we are too conservative in insurance accounting at the moment what IRD allows that. So actual value of insurance is a lot more. So both life, non-life insurance is good. Then in healthcare, again, healthcare, either the CDMOs or companies who have anything to do with GLP-1, the anti-obesity thing. So there are a couple of...
Anti-obesity, okay, yeah.
So there are a couple of companies there. We are invested in both of them. And into cement, the building material sector. Okay. There's a lot of consolidation that has happened. Plus, there are players which will likely get consolidated. So
right.
There is upside.
I have 2.5 minutes left. So one quick question to all of you. For the next 1 to 2 years, because I'm sure in the last 3-4 months, you guys have taken a stress test of your portfolios, right? You have given more discount to your own earning estimates, which you may have, worked. Spoken to the portfolio companies very well. What is the sense you are getting when you talk to your portfolio companies? Are they confident of the earnings growth next 1 or 2 years? If you could just give us an example of what kind of earnings growth on your portfolio level are we sitting on? Because after all, market will mirror earnings growth. Returns will mirror earnings growth. What's your earnings growth of your portfolio 1 or 2 years?
Yeah, so one of the themes we are chasing is that most of the companies in our portfolio need to deliver growth between next 6 to 15 months. We don't want to be invested in companies where, the growth is little farther into the future. Clearly, there have been some managements, with the fall in prices, the confidence has also gone down.
Fallen, okay.
And, so and that happens cycle after cycle. Last 25 years, this happens cycle after cycle. So when you see that, you probably know it's an issue and maybe time to even book losses in those cases.
That's a practical point. What about you?
Yeah,
Satish, how's the earnings growth looking?
Yeah, so generally we invest in companies where we see 15 to 16% plus kind of
Your
earnings.
portfolio aggregate is 15%?
Yeah, it is upwards of that.
Balaji, you must be having 25% earning
No,
growth in your
no,
portfolio.
unfortunately not. So, see, we don't necessarily look at the, market following earnings growth thing because.
There is no terminal value in next 2-3 years, how the jump can come. Is that the area?
So, yeah, I mean, you can also have low growth companies that have been undervalued for, like, for example, the lubricant sector was completely written off, because of the advent of, but then Gulf Oil was a very good performer, over the last 2 years or so. So, essentially, we also do a lot of balance sheet investing. So, earnings growth is a priority, but we like companies where if you are able to buy a company at, say 0.5 times of fixed assets.
Deep value.
Yeah. So, we like those type of companies as well.
So idea is that your portfolio should have a higher earnings growth compared to the index. If you have to beat the market, you have to have a higher earnings growth. The next 1 year, if I look at the large cap, as I mentioned, 11 to 12% is what the market is estimating. Small cap, similar, 11 to 13% is what the market is estimating. So my portfolio has roughly around 18% earnings growth for the next 1 year, which is FY26. It has declined post the recent earnings quarter. Earlier it used to be around 24. We have kind of decreased it, and now roughly around 18.5 to 19% is where the earnings growth is.
Okay, that's optimistic, guys. So before I hand it over to the moderator, just show of hands from all 4 of you. Are you expecting positive returns in the next 12 months or flat returns? Positive returns? Positive? What about you?
I don't know.
Can't say.
Flat.
Flat returns.
Right.
Okay. So one brave call. Flat. Can't say.
I don't know.
Portfolio should be positive. Flat returns. And the last
Positive.
Flat is on
Positive?
the markets.
Okay,
Flat
great.
is
So
on the
guys,
markets.
that's a kind of I've read the mind of all the 4 portfolio managers on how to approach equities, Indian equities at this juncture. No need to be that pessimist. If you have a good fund manager, I'm sure you guys will generate some good alpha. Thank you very much.